Gold hovering near record highs ahead of PMI data out later this morning. The precious metal reaching those all-time highs following the Fed's 50 basis point cut last week. To discuss whether or not we're headed higher or if there are risks ahead that investors should keep in mind for gold, we want to bring in James Steele. He's HSBC's Chief Precious Metals Analyst. It's great to have you, James. Let's talk about where we're trading right now. We have gold right above that 2,600 level. Is there much more room to the upside, or are we likely going to see a pullback from these levels?
Well, I think we're going to see increasing resistance up here. There's a couple of things that would imply that the market is going to run into some resistance. One is that jewelry underlying physical demand is down. Jewelry is down. 50% of all physical demand for gold is in jewelry. Most of that is in the non-OECD world. That demand is slowing because of high prices. They're very price elastic. Coin and bar demand is slowing as well. Now, the problem is that these changes in the physical demand will often take a very long time to push into prices, because right now we have a lot of momentum buying in the market and a lot of technical buying, and a lot of it predicated off of expectations of more rate cuts. So near term, sure, we probably have a little bit more upside, but we're a little suspicious of it above $2,600. That's not to say that we can't move a little higher in the near term, but there are some roadblocks ahead.
How much of that is predicated and gold going higher from these levels, predicated on the Fed aggressively cutting or continuing to cut?
Yes, I think that's right. And these cuts have been well telegraphed. I mean, gold does have a history of rallying during Fed rate cutting cycles, but much will depend on how much of this is baked into the price already. And certainly after the 50 basis point cut, perhaps we won't see a cuts quite that aggressive. We're forecasting a series of 25 basis point cuts going forward. And we'll have to see what Fed speakers are going to say to imply one way or the other. But some moderation in the rate cutting cycle would tend to remove some oxygen from the gold market. You're absolutely right.
Sorry, James, can you just repeat that? What did you say was your base case or your expectation for the Fed's next move?
25 basis points for the next two this year, and and into next year.
Okay, so 50 total before the end of the year, which makes a lot of sense. And that is, largely speaking, I guess, what some market participants are pricing in. I'm curious what you make just about this entire debate, whether or not we're going to get 50 or 25 at this next meeting, and exactly what that means for the price of gold and just precious metals beyond that, just given the fact that there is so much uncertainty, and a lot of that is already being priced into some of this lead-up trade that we've seen.
Yes, well, we're looking for, as I say, 25 basis points for the next, for the meetings for the end of this year. That's probably mostly baked into the price now. A lot will depend on how the dollar reacts. We're sort of looking for a somewhat firmer dollar, not simply because the Fed is cutting, which would tend to be negative for the dollar, but because other central banks are also going to cut. And also that the US economy, as your previous speaker said, is doing well. So by comparison, the US is doing quite well. If this firms the dollar, which we anticipate that it will, then that would be a negative on gold, and that would restrain further rallies.
But with that in mind, you're also watching some of the central bank actions that, as they're initiating or thinking about cutting and that policy pathway there, they're also looking at where they might be purchasing into some of these precious metals and gold specifically. What type of buying power or buying proponent do you believe they'll continue to be and bolster the price action we've seen thus far?
That's an excellent question, and you've hit one of the really seismic changes in the gold market in the past few years. In 2022, central banks bought 1,082 tons of gold. Last year, they bought about 1,030 tons of gold. Now, this is more than double the average of the previous 10 years, which is $400, $450. So you can imagine this has absorbed a great deal of demand. Now, in the first half of this year, they've been pretty strong, over 400 tons. 480 odd, I think. Second half, I mean, we're looking for these high prices to curb official sector demand as well. It doesn't mean that they're not still on a long-term buying program, and we believe there's very good reasons that a central bank would want to own more gold. But they will also be price sensitive, and we are at very high prices. And if they're playing a long game, they don't have to rush into the market. So I think we're probably likely to see them moderate purchases in the second half of the year, which may also create a little bit of headwind for gold.
James Steele, HSBC Chief Precious Metals Analyst, thank you so much for taking the time here with us this morning.
Thank you very much.